And it is time for the word on Wall Street. Top investors watching your money. Joining me right now, SW Retail Advisors President Stacey Widlitz and Kingsview Asset Management Partner Mario Veneroso. Mario, one of the reasons for the strength of the consumer is jobs, right? We're seeing all of this job creation every month, and yet Alphabet's self-driving tech company Waymo cutting jobs, adding to the other string of job cuts we've been talking about. Waymo will cut nearly 140 employees. This is the second round of layoffs this year. That is a cut of 8% of the workforce. The stock is flat this morning. You've also got Ray Dalio's Bridgewater Associates also cutting jobs. They're planning to cut 100 jobs as part of a push to develop AI and a new platform there. Both companies laying off in efforts to focus on AI. Mario, what's your take on the jobs picture? Will it catch up with what has been a slowing economy?
Yeah, so I think the jobs picture right now, if you look at last month, they said 517,000 jobs versus 187,000 expected. So the jobs picture has been the golden parachute for the Biden administration and for this economy. But I believe that golden parachute is about to be shot down like a Chinese balloon. You have Waymo yesterday. 8% of their workforce, they're being laid off. You have Bridgewater's report that came out last night, another 8%. You have Salesforce. They're laying off 10,000 employees, wow. Maria, 10,000. So it's only going to be a matter of time before it works its way through the system. And as an investor and as a money manager, if you look at the jobs report, it's a lagging indicator. I think we're going to start having more and more of a harder landing upon the horizon.
One of our guests earlier said that the lag in terms of impact from this string of interest rates is 12 to 18 months. Yep. It's not even just a year. I was thinking maybe it's a year lag. He's talking as much as 18 months. So if that's the case, we haven't felt any of this yet.
100%. So if you look at history, and they often say history doesn't repeat itself, but it often rhymes, it's usually about a 2-year barometer for the Fed with their tightening cycle to start moderating their interest rates. So what happened last year? We went from 0 to 4.25 interest rates. Yeah. The Fed funds is 4.5 right now. It's going to take some time, and I agree with Brian Moynihan, who recently said that you have to give the time for the structure to work, and I think there could be more volatility ahead.
Would you buy stocks here?
So it depends on the investor and your time horizon, right? So there's certain sectors, you know, David Ihorn said yesterday, right, there was bubbles brewing in the market in 2022. You saw the NASDAQ go down 33%. Yeah. So I'm a disciple of discipline. I like value, Maria. I want to get paid now with cash flow, strong dividends, and I want those companies to raise dividends in the future. So the answer is yes, but I would be very selective.
Stacey, you agree with that? You like value over growth?
You know, I think there are some names in retail particularly that you can look at for growth here. And I think we're headed into a major reset, right? Last year we had way too much inventory, and now everybody's paring back. So you can see some operating margin growth here. And in the out years, certainly there are some names like a Target, certainly a Walmart, brands like Nike that you can absolutely own for growth here for a multi-year period. Okay. I think the best brands out there, we're going to go into a period of stabilization, again in the operating margin cycle, and then return to revenue growth. I think, you know, you certainly want to avoid stocks like a Kohl's that are less relevant now. Yeah. They don't have the one-stop shopping, they don't have food, they don't have consumables, and becoming less relevant. I think those, you don't want to really look at them and say, wow, cheap multiple, interesting here. I would avoid those.
Yeah, which is your point. You've got to be selective in this environment. Stacey, Mario, great to talk with you. Thanks very much. We appreciate it. Thanks for the word on